This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi. Stroud-Watts in Sydney. The top stories this hour. Japanese stock futures are pointing to a rebound after the market's worst day since 1987. The yen is steadying after its surge following the BOJ rate hike, and investors also awaiting an RBA decision. Signs the US economy is in the danger zone, driving the S&P 500 to the brink of correction. Treasuries losing some steam after two-year yields briefly topped 10 years. And we continue our exclusive coverage inside Adani, speaking to Gautam Adani's eldest son about claims that the family fortunes are too closely entwined with the Modi governments.
Being close to a political party does not necessarily mean that you get the work. You get the work because you are able to deliver.
Well, let's get you straight to today's agenda. And Shery, top of mind is really the global stock meltdown, right? Take a look at this terminal in terms of the context of what we've seen. We've seen now the S&P 500, as I mentioned, now on the brink of correction. The question is, and we were talking about this before we came to air, we've seen previous kind of signs of capitulation in these markets that have very quickly bounced back, right? Is this time kind of for real, I guess, in terms of some of the repricing that we're seeing? In fact, our question of the day on the MLive blog is, will the S&P actually end the week higher or lower? But no question about it, this recent sell-off has been one for the books, no matter what asset class you're looking at.
This is a positioning-driven sell-off.
We're dealing with a correction that, it's a terrible word to use, but it's somewhat healthy.
We're going to see the ripple effect in tech.
Some of what's happening in tech is just, you haven't really had a correction in a long time.
This is just an opportunity to deploy some cash that's sitting on the sidelines.
Tremendous opportunity here from an active manager's perspective.
I would just be cautious and kind of take your time over the next couple of months, because I don't think today is going to be our final down day.
The markets certainly are panicky enough to have an impact on Fed thinking.
I'm not yet in the camp where we'll see an aggressive rate cut, intra-meeting cut.
You might get a bounce in the markets, but I think the overall signaling that would send to risk assets would be a negative.
That would be really sending panic signals to the market.
That global sell-off overnight has been amazing, right? I mean, started in Tokyo, then London, then New York. Now, for me, the key question will be, are these losses sustained? Because we have seen this sort of knee-jerk reaction and sell-off before that wasn't really sustained, and then you saw the bargain hunters coming in and supporting the markets again. Well, it comes to the Japanese stock market, though, we're like plunging into bear market territory already. We've erased all of those gains that we saw in the past year. So we're talking about the topics down now, 24% from its peak. We're seeing the Nikkei volatility also at the highest level since data was kept in the 1990s. So take a look at how we're setting up right now with Asian futures trading like this as we continue to see a little bit of strength in the Japanese yen. And of course, we're talking about a rally of double-digit percentage gains since its July low. Now, Sydney futures at the moment down 0.4%. It's RBA day. Let's not forget that, because we do have a big rate decision that could potentially be a hawkish hold in Australia as well. Nikkei futures pointing to the upside, 1.4%. Of course, we'll be watching some of those big names like SoftBank that took a tumble, not to mention those banks as well. We continue to watch what's happening in China as well. Of course, we had some priorities set by the government, but of course, confidence in the markets has been lower. Take a look at how U.S. futures are coming online in the Asian session, given that we had that big sell-off. We're talking about the S&P 500 losing 3% in the overnight session. We're seeing a little bit of upside, 0.9%. Will we see those bargain hunters jumping in again to get some good deals after we saw record highs in the U.S. markets? Nasdaq 100 saw its worst start to a month since 2008, but we're seeing futures now pointing to the upside of 1%. We'll be watching the Treasury space very closely, because we saw the 2-year yield fall below the 10-year yield for the first time in 2 years. What that says is that really traders are pricing in potentially more aggressive easing and faster. One time even pricing in 60% chance of an emergency rate cut. We're seeing some upside in oil prices as well. And despite the volatility, our first guest is staying invested in stocks, seeing healthy profit growth this earnings season. Sylvia Jablonski, CEO and CIO at Defiance ETFs, and joins us now from New York. Sylvia, always great to have you with us. And really, you were telling us before we came on air that you've been picking up some of those big tech giants. If these futures are correct, you might not be the only one.
Oh, well, thank you so much for having me. I think it's very difficult to time the markets, but what I do know is that I was buying these stocks at much higher prices than they're at now, and I continue to have the same belief system that, AI is the future of technology. There's a significant amount of growth opportunity within AI and innovation, and these top tech companies are the ones who are the leaders in that space. Not only that, but they're returning, right? They had a solid earnings season. They maybe didn't meet the expectations of the street, but for all accounts and purposes, they've done incredibly well. They're growing in all areas of the market, and particularly things in the AI space like web services, NVIDIA chips. You heard every company talking about the need for chips, and the hiccup today about the potential defect. Again, that gets sorted out. That pulls the stock back even further. And to me, it looks like a good buying opportunity. It's that old saying, right? You buy when there's blood in the streets, and there's a lot of blood in the streets.
Yeah, at least markets got a little bit of support when we saw the services numbers from July in the U.S. actually expanding. Is it all about economic data at this point and whether or not the Fed is able to achieve that soft landing?
I think it's hard to say because everything was looking pretty rosy prior to, all the jobs number, that 4.1 to 4.3%, right? I think that was an initial trigger, but I wouldn't have expected the market to react with such a haste and panic the way it did. And so I think that the Japan story, the carry trade, is actually what's causing a little bit of chaos in the markets. And I think that, there really has been an immediate reaction to that, to essentially, borrowing something cheaper, the yen, and using it to buy something with a higher yield like U.S. tech stock. And when that kind of breaks apart, you have this, disruption within the market. And I think that's a lot of it, because if I look at the economy, wages are still good. Unemployment number is well within historical averages. 4.3% is certainly not a bad unemployment number. We have earnings growth of about 10%. Corporate earnings look good. Fundamentals look good. It's not all rosy. There's geopolitical tensions and kind of uncharted things that are happening in the market. But I think a lot of it was the Japan carry trade and not so much the economics.
Sylvia, and to that point, if this is sort of a bit overdone and a bit of a knee-jerk reaction, as Shery said, as we've seen in previous times before, our question of the day on the MLive blog goes to this, right? Do you think the S&P 500 is going to end the week higher for lower? And I suppose some of the things that you talk about, earnings are still pretty robust. Is it just going to be a higher kind of threshold that we're going to want good earnings, easing from the Fed, improved US data, valuations to be more attractive, and to kind of get to that, we're going to have more bouts of volatility ahead?
Yeah, and see, I love how you laid out that question, because to me, it sort of feels like we want it all in order for it to sustain, right? And that's unlikely. And so I think we're going to have that volatility in the near term. I have no idea whether the S&P will end up, up or down this week, but I do know that the S&P is well off of its highs, as is the NASDAQ, as is the Russell. And I do think that, again, the economy is fundamentally strong. Corporate earnings are good. Seasonality is kind of bad, but if I'm a dollar cost averager, which I am, and somebody who likes to hold stocks for long periods of time, I can't time the market. I don't know if this panic stops in a day or two, or if it takes a week or two. But I know that eventually it does revert to the mean, and I still expect us to have a positive year end with the S&P and the broad-based indices. A little pain for a little while, but again, opportunities to buy on the dip.
We've talked a little bit about tech already, and obviously perhaps some of those valuations coming down would make an attractive entry point. Pharma is the other one that you're still constructive on, right? Do you think, to an extent, what you see when it comes to some of the healthcare space, Eli Lilly is immune to the cyclical volatility? Yeah, so I do like the healthcare space. I think those stocks are getting a little bit beat up like most others, right? And but I think if you look at kind of the menu of products that they have, particularly the GLP-1s, but also cancer research, diabetes research,
different types of metabolic disease research and drugs and things like this. And I think that the company has done so well because of the GLP-1 phase. It's the kind of thing that, regardless of whether or not the market pulls back, people will need their weight loss drugs. They'll need their various medications. So they are defensive names. And I like Eli Lilly because it's, strong balance sheet. They pay a nice dividend. And again, it's also a name that you can buy on the dip, just given these last couple of days. But long-term, healthcare is a great portfolio diversifier. And then bringing AI back into it, if you think about kind of like supercomputing, quantum computing, what happens with those drug trials, the precise information we get from data in the future, the way that they can kind of create drugs in the future. I also think that there's a lot of runway for these names to run because of what's happening in tech.
Sylvia, you mentioned earlier some of the knee-jerk reaction has been the unwinding of the global carry trades. I wonder how much exposure you have in emerging markets because, of course, they took really the brunt of the beating given the appreciation and very fast of the funding currencies like the Japanese yen and yuan. Is this too big of a risk when it comes to investing in these markets now?
I think, again, it'll be a short-term panic story. It might take some time before you see investors piling back into or adding at least new positions. But I think like anything else with risk assets, when the markets kind of settle down and we see that, the U.S. economy in particular, you're talking about 2 to 2.5% GDP, inflation coming down, jobs steady. As long as we don't have any major kind of geopolitical conflict, if we get stability in the U.S., a lot of times that does filter out to Asian markets and European markets. And so we'll probably see that stability come back across the board. But it's probably not something that I'm looking to buy today. I just want those strong balance sheets for now.
Sylvia Jablonski, and that's fair enough. CEO and CEO at Defiance ETFs. Really great to have you, particularly on a day like today, as we wait to see, what the Asia session holds in store. Coming up next on the Asia Trade, we'll be talking more about market strategy during these volatile times. JB Weir and Capital.com will be along with us. What comes next after the manic Monday meltdown, and have things changed for the RBA as well? CLP CEO TK Chiang is also joining us to discuss profit outlooks for the power generators, Hong Kong and Australian businesses. Plus, as our special coverage of the Adani empire continues, we hear exclusively from Gautam Adani's eldest son, Karan, who oversees the ports, cement and logistics businesses. This is Bloomberg.
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's hand-picked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive, premieres Friday only on Bloomberg.
Take a look at how currencies are trading at the moment after amazing volatility that we saw in the overnight session. Of course, the Japanese yen really has strengthened in the double-digit percentage points overnight when it comes to that July low. But right now, we're seeing a little bit of weakness against the U.S. dollar. Trading past that 145 level. And of course, the yen, one of those very popular funding currencies, together with the yuan, and then pushing higher in the past week, that sudden appreciation really leading to that violent unwinding of global carry trades. Let's discuss with senior markets editor and Bloomberg opinion columnist John Authers. And John, we saw really the impact on LATAM currencies, for example, Mexican peso, Brazilian real, really taking a dive given this unwinding of global carry trades. How impactful has this been, and can we expect it to continue?
Well, on the carry trade, it certainly could continue a little further because it was remarkably overdone coming into this. Amazingly, there was more money to be made during the Mexican carry trade from the beginning of this decade, i.e. shorting the yen and putting it into the Mexican peso, than there was in simply just going long the S&P 500. no currency pair should be making the kind of that kind of money for that kind of time. So it's obvious that there was a lot of speculative excess in there, which is now on its way out. I think the big question for a lot of what we've seen so far, everybody could see things like the carry trade, the Magnificent Seven stocks looked badly overdone. The question is whether we have been able to correct those obviously overdone trades without causing the kind of damage that will have a real-world domino effect. In other words, is there a long-term capital management hedge fund equivalent in this situation? Is there a Lehman Brothers? I guess that's the critical question. If there isn't a serious institutional casualty, then yeah, we'll muddle through this. And if there is, then we ain't seen the end of this yet. There's going to need to be big changes in policy before we can get through it.
And, you know, obviously the nature of black swan events is that we can kind of talk around them, but nobody really knows when they're going to pop up, right? But it's interesting looking at black swan hedging and, you know, obviously the big surge in the VIX index. But, you know, some of these numbers that we saw suggest that they are expecting, you know, the potential for the S&P to fall by 3 deviations, which is pretty crazy. I do wonder whether that event could be US politics driven or geopolitics driven, sort of Middle East driven. Are those sorts of factors weighing at the moment, in addition to what you say, you know, the sort of traditional financial institutional failures that we might be watching?
I don't think it's because of those, but I also don't think it's helping. So basically the market turned, you started seeing this huge rotation after we got the CPI, the US inflation numbers for June, and that happened to be 2 days before the day when Donald Trump was shot, and only 9 days before President Biden announced that he wasn't going to be running for re-election after all. So there's obviously been a lot of politics going on, and that can't be reassuring for people. I don't myself believe that there was much in the way of a Trump trade. Plainly, Donald Trump was beginning to look almost invincible, and we're back to seeing this as a roughly 50-50 race. I don't think too much money was deployed on the assumption that Donald Trump was definitely going to get back in again. If you are, in terms of handicapping the presidential election, though, plainly there's talk of tariffs. They may be a good idea. They would not be good for the market. They would be thoroughly disliked by, generally speaking, people who trade in markets like free trade, not protectionism. So that's certainly a risk lying in the future, but I don't think it's driving what's happening now.
So, John, we're now seeing a lot of flack for the BOJ because they hiked rates last week, and now we have this financial meltdown. I mean, they were backed against a corner if you have the Japanese yen trading at multi-decade lows. We are getting labor cash earnings just at the bottom of the hour. So I guess we'll see if the economic data really back their hike. How difficult of a situation is this for central banks around the world? Because if you have this much financial volatility and reaction in the markets, is this something that could change the calculus for, say, the Federal Reserve?
Yes. If you have something like long-term capital management hedge fund that melted down in 1998 as part of the turbulence that followed a Russian default, that eventually led the Fed to cut rates several times when they hadn't previously wanted to. So you certainly can imagine something like that happening again, that you could see a move, that the fallout from what we see from the markets will move central banks. In general, I do feel somewhat sorry for Ueda-san. I don't know if I pronounced that rightly, but I do feel a little sorry for him. There were a number of central banks made announcements last week. The 3 really big ones were the Bank of Japan, which hiked, the Bank of England that's cut, and the Fed that stayed the same. Everything might have been, if all 3 of them had done the same thing, this would not have happened in the way that it has. I'm not sure that you can single out the BOJ for any more opprobrium than you can the Fed for not doing anything, or the Bank of England for cutting. I think the combination of them, there is this analogy with mountains that central bankers use, that climbing back down the mountain is much more dangerous than climbing up it, and it's particularly important you're coordinated. When you're a mountaineer making a descent, you all need to be roped to each other. Last week was a week of uncoordinated central banking action, and all of the central banks involved do take some of the responsibility for the mess that's resulting.
Senior markets editor and Bloomberg opinion columnist John Authers there. Well, of course, we're looking ahead to the RBA, expected to hold its key rates steady when it announces its policy decision in a few hours. Bloomberg Economics sees the central bank sticking, though, with its hawkish stance. Our economic reporter, Swati Pandey, is with us. So I guess the question here, I think last time I looked, there was maybe a 10% or so, slightly more, cohort of the markets that are actually seeing a cut today. Have the events and some of the worries over the eco data in the US created even more concern that the RBA, already seen as being behind in the cycle, should be moving quicker?
Definitely, what we've seen in the past few days has had that impact around what the RBA should do or will do. But if you see what the RBA did during the tightening cycle, we were slower in raising interest rates. So at 4.35, we are still a lot below where the Fed is at the moment. It's highly unlikely that the RBA will cut today, even with that 10% market pricing. But the big question is whether they will signal that, we are done raising interest rates, because so far they have been saying that we could raise interest rates, right, depending on the data. So do they drop that hawkish bias or not? Do they signal that it's time that we start talking about easing, and whether easing was on the table in today's meeting? That's going to be important as well.
And, you know, we've heard from Fed speakers saying, look, the Fed doesn't react to just one piece of data, right? Are there key pieces of data that the RBA would be looking at the moment, and how does that kind of guide us into what the next few meetings look like?
Look, it's really important what the Fed does, right, for the RBA. So that's critical. China's economy is also important because it's our #1 trading partner. RBA's mandate is, of course, having inflation in that 2 to 3% target. The latest data showed that core inflation was 3.9%. So it's closer to that 4% rather than the 3% where they would want it. The good news was that it deaccelerated a bit. It was lower than expectation, and it was broadly in line with what the RBA had forecast. So that was on the positive side. But inflation still remains stubbornly sticky for the RBA to put their guard down at this point.
Our economics reporter, Swati Pandey, and certainly a very interesting RBA decision on tap today. More ahead on the Asia Trade. This is Bloomberg. Take a look at some of the latest stories we're following from around the world. And US Secretary of State Antony Blinken says officials are engaged in intense diplomacy to avert a wider war in the Middle East. He says the US and its allies are working to head off a potential Iranian attack on Israel, urging all parties to refrain from escalation. Tehran has warned that it will respond after blaming Israel for killing a top Hamas leader last month in the Iranian capital. Bangladesh's army chief and president are calling for calm after Prime Minister Sheikh Hasina fled the country following anti-government protests. Authorities say a curfew will be lifted on Tuesday. Elections will be held as soon as possible. Hasina had faced pressure to resign in recent weeks as peaceful protests over government job quotas turned deadly. More ahead on the Asia Trade. This is Bloomberg.
We have breaking news out of Japan. We are now getting the labor cash earnings, year-on-year growth of 4.5% for the month of June. This is a real beat from what economists had expected, and it's also growth from the previous month. But what we're really watching right now are real wages, and we're talking about real cash earnings, year-on-year growth of 1.1% for the month of June. This is now the first time the real wages have turned positive in 27 months. So that would be the last time that we saw it in positive territory was March of 2022. For more, let's bring in Japan economy and government reporter Erika Yokoyama. And Erika, really interesting because we have seen the Bank of Japan get a lot of flack given the financial market meltdown because of the rate hike last week. But if you take a look at the wage growth data, potentially they were backed by the economic rebound.
That's true. This is like a long-awaited moment for the BOJ. Finally, the strong wage gains from this year's wage negotiation is clearly showing up in the monthly wage data in a confirmation of positive cycle between wages and prices. And that's a relief for the BOJ that raised the interest rate last week amid some weakness, the signs of weakness in the economy, including like weak consumption and output. So yeah, and some said, as you said, like BOJ partly caused the recent market turmoils of like sharp yen's appreciations and stock market free fall. So yeah, with the BOJ's premature rate hike decision. So I think this is actually a reassuring piece of news for the BOJ in that sense as well.
Yeah, I mean, despite the criticism that we've seen, we're actually seeing the economic numbers turning positive. But at the same time, I guess, given the financial meltdown that we've just experienced, I wonder what happens to the BOJ tightening policies going forward. What should we be watching out for?
So wage is going to remain a key indicator as the bank wants to see the continuity. I actually think the upward pressure on wages will remain to some extent given the tight market conditions and strong corporate earnings and other factors. And other things that the BOJ should be paying close attention is include, of course, inflation and consumption gauge, and also the GDP figures for April through June will come out next week, which will be the very important indicator to tell where the Japanese economy stands after a deep contraction in the first quarter. You know, Ueda hinted last week after the decisions that the bank may consider rate hike if prices and economy moves in line with the BOJ's projection. So yeah, the market has to keep close eye on every single data coming out from Japan and understand and grasp the economic strengths comprehensively.
In the meantime, we're still seeing that weakness or the sluggishness in the household, right? June household spending rising just 0.1% month on month and actually falling 1.4% year on year as well. So, you know, what will it take to get that virtuous cycle going, I guess? And what are some of the implications potentially for government policy?
Right. Yeah, consumption is still a little bit weak because of the inflation lingering on. However, today's strong wage gain is a pretty positive development for Kishida, and especially, and higher wages could probably boost the consumption together with the tax rebate that the government implemented in June. However, at the same time, Kishida also has to be a little bit mindful of the negative side of the recent market turmoils because it could worsen sentiment among lots of Japanese people who recently started investing in stocks through the new NISA system rolled out this year. So yeah, Kishida has to be a little cautious about the spending trend and public sentiment going forward, especially before the LDP party leadership elections and general election expected for this September.
Japan economy and government reporter Erika Yokoyama there in Tokyo. Of course, we're watching the RBA with the central bank here in Australia expected to hold that key rate steady when it announces its policy decision in a few hours, keeping the bank trailing the field in the global easing cycle. We're expecting that hawkish hold to be maintained too. Let's discuss all of this with Sally Auld, who's the CIO at JBWare, who joins us now in our Sydney studio. Sally, so great to see you in person after what has been a little bit of time. I do wonder, do you think the events of the last couple of days have changed your views at all, given that the RBA was sort of considered to be behind in the cycle anyway?
So I think a couple of things going on. I mean, the first thing to say is there's plenty of reasons for them to do nothing at the moment. So inflation wasn't nearly as bad as everyone feared. And so they will take the opportunity to say, look, it came in broadly as we expected. We still think we're in a disinflationary trend. Maybe we've still got scope to tread that narrow path. So that's sort of the domestic story. They will be mindful that the economy, some of the data that we've had has been pretty robust. So the labour market's still strong, housing finance, business credit growth, they're all pretty robust as well. And so I think there's still some way from putting up the white flag and declaring victory on inflation. I wouldn't expect to hear that from the governor this afternoon. However, when we look around the world, it's really clear from the US that that economy is slowing, and perhaps even a bit more faster than people anticipated. That was really the message of the jobs data, and the US unemployment rate is now 90 basis points higher than where it troughed for the cycle. So the US has sort of now joined other countries like Canada, New Zealand, where we've seen quite an appreciable rise in unemployment rates. And so I think the RBA will be watching that dynamic pretty carefully. And then clearly, on top of that, we layer everything that's happened in markets in the last couple of days, which at this stage, I think my inclination is to basically say, what we're looking at is one of those situations where you had a number of markets that were extreme valuations, whether that was the tech sector, whether that was the Japanese yen. You had a small handful of really broadly and well-subscribed consensus trades, so people were very asymmetrically positioned in some of those trades. And then we had a piece of information that came along on Friday, being the payrolls number, that forced a bit of a reassessment of the economic outlook and has really prompted a widespread deleveraging of all of these consensus trades. So I don't think central banks are going to be worried per se about this move in markets. And I think fears around or talk about an intermeeting Fed rate cut are very overdone at this point. But I don't think that has massive implications for the RBA. I mean, markets were sitting, including our own stock market, at all-time highs before this happened. And so, a 10 or 15% correction is not massive in the overall scheme of things. What's going to be really key here, and what is increasingly the biggest difference between Australia and the rest of the world, is our labour market. We've got an unemployment rate at the moment of 4.1. Yes, it's higher than where we troughed, but that is still very much full employment here in Australia. And so if that sort of dynamic or that differential continues, other unemployment rates going up, ours holding in the low fours, then I'm not sure that there's necessarily a really strong case for the RBA to be doing anything. And if inflation, which didn't come in as bad as everyone feared, sort of continues to hang around that 0.9-1% per quarter, that's not disinflationary enough to get inflation back to where the RBA needs it. So, and
there's maybe some upside risks from China if some of these pro-growth policies actually do start to take
Yeah, correct. So, I don't think I'd be banging the table that, the RBA's on the cusp of hiking rates, but I don't know that I would yet be at the point where I'm completely willing to say that I'm 100% certain the next move in rates here in Australia is down.
From a CIO perspective, do you look at the events of the last couple of sessions, and see opportunities now?
Yeah, that's very much how we'll be looking at it. So, we take the investment philosophy that the best way you can build portfolios and investments over time is to buy the cheaply valued assets. And so when we get corrections of this magnitude, and we've seen some stocks correct sort of 30+%, we will be starting to identify those opportunities. And I'm not sure we're at the point where we'd be dipping the toe in today, but it's quite possible that in a week's time or thereabouts, we would be looking to actively add some of those significantly derated sectors or stocks to the portfolio.
Right. Sadly, so we've saw really that violent reaction when it comes to the markets, to the Australia CPI numbers, to the US jobs numbers. What should we be on the lookout for the next big reaction from investors when it comes to data out of Australia?
Yeah, so I think the really key data here are going to be the labour force data. So this economy has added 250,000 jobs in the first 6 months of 2024. And while people might sort of, discredit that and say, well, all the jobs have been in government sectors and so therefore it's not a reflection of the underlying strength of the economy, I think the point remains that these jobs still put incomes into people's back pockets and so therefore matter when we think about that imbalance between demand and supply we have in the economy. So for me, I think that the most important things from here are going to be activity indicators. So I think we'll be watching the labour market really carefully, job ads, because they are a leading indicator of labour demand. And then, of course, having a sense of what consumption is doing, because we know we're in a period where stage 3 tax cuts have hit. And when you look at most people's forecasts for the next 6 months, people are envisaging consumption, household consumption picking up. And so I think the retail consumption story and the labour market story and the labour demand story are probably the 3 key indicators to watch locally.
Sally, when it comes to the markets, it feels like the threshold for gains are going to get higher, right, and potentially more volatility to come. Do you look at things like what potential, grey or black swan events might be lurking around the corner? Do you worry about politics or geopolitics?
Yeah, absolutely. So I think those things are sort of always with us. And, we do, I think acknowledge that we're in a world where geopolitical risks and issues are sort of feel like they're more prominent than they have been maybe relative to the past 20 years. And we could be in a world where we're transitioning from an environment of low and stable inflation, perhaps to a world of higher and more volatile inflation, and that might make management of the macro cycle more difficult than it has been for central banks, and so you could get volatility from there. So, one of our longer term, I guess, ideas or the way we think about markets is that, yes, investors should be expecting more volatility in markets. They need to be more nimble. They probably need to hold a bit more liquidity in portfolios than they might have done in the past. But, at the end of the day, in those circumstances, really the only weapon you have to protect yourself is running a really genuinely diversified portfolio, and that's something we advocate very strongly to our clients.
Sally, really great to have you with us. Sally Auld, who's a CIO at JB Ware. Let's get you across the early market action. As we set up in Asia, we're just about 15 minutes away from the start of trading after that global sell-off in the Monday session. Garth Reynolds, who leads our Markets Live Asia coverage, joins us now. And Garth, you're obviously asking the question, by the end of the week, do we have the S&P higher or lower? And it seems like it could very well be the former, right, from at least the number of people that we've spoken to this morning.
Yeah, the markets do seem to be getting a little bit calmer. Now the difficulty is, of course, is that something that's just like a dead cat bounce, or the waves of selling look like they're exhausted for now. The difficulty is what else could come. One big obvious potential concern is if the Middle East situation escalates, but there are also a lot of investors nursing some pretty strong losses. The difficulty is what they need to come back in. We could see calmer heads prevailed. I think we want to see bond yields come back up a bit so that you get a reduction in the pressure about whether or not the Fed is going to have an intra-meeting rate cut, whether or not it's going to cut by 50 basis points. The signalling so far from Fed speakers has been that they probably will indeed cut rates next month, but do so by 25 basis points unless the data gives them reason to do otherwise, and they mostly don't regard stock prices as data. So passing all of that, we just need some calm. We need the VIX to come back down from the extreme levels it hit. If we do get that, then you would expect, at least in the short term, a bounce. The S&P actually fell for 3 straight weeks coming into this week, so a 4th straight week would be the worst performance since September last year. That biases things towards the idea that there will be a rebound, at least in the short term, that will deliver a weekly gain.
Should we be worried at this point about systematic funds continuing to offload more of these global stocks? We heard from Morgan Stanley that they probably offloaded about $70 to $80 billion of shares just on Monday, and we're talking about strategies like risk parity, vol targeting, and trend, for example. I mean, a lot of these moves have been so violent that we just have to keep watching whether these funds just automatically offload and wipe out billions of dollars from global markets.
Yeah, well, that's why the next couple of days are going to be so key, and especially that need for calm. The current market setup is very much favouring momentum trades. That's what helped to send things higher than a lot of people thought that they really should when it came to equities. But the momentum, the trend was everybody's friend until it wasn't. So if we get that calm so we can, break the momentum plays that would otherwise send things back down. That's why, again, the dollar-yen level is going to be so key. It looked yesterday as though it might actually test 140, which would have been quite an extraordinary outcome. It's pulled well back from that. My colleague Mark Cranfield was writing that if you look at what the dollar-yen did back in 1998 when we had a lot of volatility, it ended up settling into a fresh range, considerably lower for the dollar-yen back then than it is now. But if we get that sort of thing, if we get dollar-yen sitting between 140, 150 going forward, that's, one of the things we're really going to look at and go, okay, so at least a serious amount of the liquidations have taken place. We can start looking for value instead of jumping into and out of the volatile moves that break out.
Yeah, at least right now, futures trading look a little bit more positive. Garfield Reynolds, who leads our Markets Live Asia coverage. This is Bloomberg. Welcome back. We have more now in our exclusive series taking you inside India's Adani Group. Karan Adani is billionaire Gautam Adani's eldest son, who oversees businesses including cement, ports, and logistics. They provide much of the critical infrastructure, allowing global companies to plug into India's $4 trillion economy. Adani is now planning to take over seaports in the Middle East, Africa, and Southeast Asia as it tries to challenge China's dominance in key trading infrastructure. In our exclusive interview, Karan Adani also dismisses allegations that the group's fortunes depend on their close ties to Prime Minister Narendra Modi.
This man holds the keys to one of the biggest logistics businesses in Asia. Karan Adani is the eldest son of Gautam Adani, the Indian billionaire who built a sprawling infrastructure empire that's pivotal to the country's economic ambitions. He's been handed the reins to some of the most important businesses for the Adani Group, including ports. Karan is visiting the Mundra port in India's Gujarat, the home state of Prime Minister Narendra Modi, whose policy priorities the Adani Group has closely tracked as part of its business strategy. Mundra is where it all started for the group, which is now India's biggest private operator of ports. Maintaining and building on that growth will be a key challenge for Karan. He is one of the 4 family members handpicked to run big chunks of the Adani empire as part of his father's succession plan. However, the firm's meteoric rise has been overshadowed by accusations it's benefited from cronyism. It also took a multi-billion-dollar hit from the explosive Hindenburg research report, with a short seller claiming the Adanis engaged in fraud and stock manipulation, allegations that they've denied. Bloomberg's Anto Antony sat down with Karan Adani for an exclusive interview and asked him about the challenges ahead.
The group's rise has been closely linked to Prime Minister Narendra Modi, but at the same time you are working in several other states with other governments also. How do you do the balancing act there?
Being close to a political party does not necessarily mean that you get the work. You get the work because you are able to deliver, you are competitive in a market, and we have run it in a most efficient manner. You don't have these 3 things. There's no point being close to any political party, because today's India is no more about giving favors.
When the Hindenburg short seller attack happened, it must have taken a lot of management bandwidth and mind space away from chasing this vision. Now, how did you deal with it personally, and what role specifically did you play at that time?
So at that time, basically my responsibility was 3 things. One is obviously to make sure that business resilience continues, not just in ports but across the group, in terms of our performance, in terms of our operational efficiency, in terms of our capital capex efficiency. So that was number 1. Second was to ensure that from a leadership perspective, we were completely aligned. There was no critical people leaving during this time, and they were ensuring that we were all working together to achieve the goal, to make sure that we weather the storm. And that's what that was a main priority, to make sure that whatever performance parameters that we have achieved in the past, we beat that during this period.
Karan Adani there speaking exclusively with Bloomberg's Anto Antony. Our special coverage of the Adani Group continues all week. We'll be hearing from Gautam Adani's nephew, Sagar, who oversees the group's power businesses. And our coverage culminates with a special report on Friday at 11:30 a.m. Hong Kong time. There's also an encore presentation at 7 p.m. or 4:30 if you're watching in Mumbai. Shery.
And Haidi, that strength in the Japanese yen, pretty short-lived right now. We're seeing, again, losses by the Japanese yen against the U.S. dollar of more than 1%. So we're nearing that 146 level again. And as we see these losses in the Japanese yen, we're also seeing some gains in futures trading in Japanese stocks, so much so that a circuit breaker was triggered for Nikkei 225 futures. We're talking about the circuit breaker being in place until 8:55, just before the markets open here in Japan. You can take a look at those gains that we saw in the Topix futures of more than 10%. We have more ahead on the Asia trade. This is Bloomberg.
Time for morning calls ahead of the Asia trading day, and JP Morgan's trading desk says the market is getting close to a tactical opportunity to buy the dip. That's on the back of a broad sell-off in stocks on Monday. They note that retail investors have slowed down when it comes to buying stocks, and hedge funds have been net sellers of US equities. They also believe the rotation out of tech might be, quote, mostly done. Meanwhile, investor Bill Gross says he's not buying nor selling small recoveries. He says markets are too volatile with bid-ask spreads extremely wide. He also says there's too much leverage in the global financial system with the strength of the Japanese yen and overdone treasury yield declines, which are key to those unwinding of those carry trades. Shery.
Yeah, because we continue to see, of course, the volatility in the markets right now. We're talking about a roller coaster ride. And when we started the show an hour ago, I was wondering if we were going to continue to see that sell-off, because that knee-jerk reaction seems to be going the other direction right now. We're talking about Nikkei futures, circuit breakers being triggered as the market is now rebounding. We're talking about Nikkei futures up 8% in fact. And when it comes to the topics, no circuit breaker there. So we're talking about gains of about 10% as the Japanese yen is again weakening. That strength really didn't last long. We're talking about gains of about 1% against the U.S. dollar. We'll see how we come online at the top of the hour. The market opens in Tokyo, Seoul, and Sydney are next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens after the global sell-off that we saw overnight. But the turnaround seems to be amazing right now, Haidi, because futures are now pointing to some upside in the Asian session.
Yeah, perhaps not so when it comes to Japan, right? We really see potentially another kind of whiplash session for Asian markets, with Nikkei futures, the circuit breaker there being setting that tone for further volatility. Remember, Shery, we also have that RBA decision as well. What a time to be making a central bank decision. Still expecting, of course, them to not do anything. We're watching to see if that hawkish bias is retained or dropped.
I was going to forget about the RBA at this point, because we are seeing so much market volatility right now, and we're watching Japan so closely because that yen strength really was short-lived. We're talking about gains against the U.S. dollar in today's session of more than 1%, as you can see, and headed towards that 146 level. And when we're talking about the Nikkei coming back from the worst day since 1987, gains of 2%. The Topix also down more than 20% since its July peak, and right now we're seeing gains of about 2%. Of course, very importantly is economic data. When it came to the Wall Street overnight session, we also had the U.S. services data expanding in July. That led to a little bit of support in the markets, despite the fact that the S&P 500 was down 3%. Today, we saw real wage growth in Japan turning positive for the first time in 27 months. So if there was criticism seeing this financial meltdown in the previous session in Japan, perhaps some of the economic data seems to support the BOJ rate hike last week. And of course, questions about what happens next is key. Take a look at how the Kospi is coming online, because it also saw the worst day in more than a decade or so. And we're talking about those chip makers, Samsung, SK Hynix, leading the losses in the previous session. And take a look at that rebound, the Kospi up more than 4%, as we're seeing a little bit of stability and perhaps weakness when it comes to the Korean won. 1370 is the level, Haidi.
Yeah, take a look at how we're setting up for RBA decision day when it comes to the start of trading this staggered session. Just coming online here in Australia as well. And as I mentioned, we're not expecting major moves from the RBA. Of course, we still have stickier components of inflation despite some moderation of the recent readings, but certainly not really enough to compel any kind of easing immediately. Just watching out for that hawkish bias, of course. We're also watching earnings season. Analysts are expecting a pretty soft earnings results from the ASX 200 cohort, and that could potentially risk deeper losses for Aussie stocks, which until very recently were still trading at these record highs, right? So we're looking for that dividend outlook as well as commentary from the RBA today in terms of what drives the next moves. But markets have really trimmed forward expectations for earnings by almost 4% over the past year against the comparable rise that we've seen in the Asian peers. We are seeing just a kind of stability going into the start of the session. The Aussie dollar also holding some of that upside, 65.19, potentially also getting some boost if we see those pro-growth messages really translate to policy out of Beijing as well. Treasuries, Shery, getting a little bit of a breather after we just saw some remarkable developments in the overnight session. That 2-year yield below the 10-year for the first time since July 2022.
Let's dissect these market moves. For more, let's bring in Kyle Rhoda, senior market analyst at Capital.com. Kyle, great to have you back. So when I started the morning, I was thinking, will this sell-off continue? Because what we saw overnight and in yesterday's session, especially here in Japan, looked like apocalypse. But at the same time, we have seen this play out in the markets throughout the year, right? You have a sell-off and then you have those bargain hunters coming back in. Is this level of support going to be sustained, do you think?
Well, it comes down to a question of discussing what's actually reflecting fundamentals in the market and how much of price is basically reflecting technical factors which, can be resolved if we start to see some of those, fundamental signs which, set off this kind of move in the markets, stabilise, if you will. For example, we saw the ISM services number last night, kind of easing concerns a little bit. Effectively, I think what we've seen here is, a spark from US economic data, really being fueled by some technical factors in Japan, which is, of course, this kind of short squeeze on a very overcrowded trade in the yen, which further compounded this kind of unwind of the carry trade, as well as, obviously, a very significant move in the NIKKEI, which is really just an inverse trade on the yen at the best of times. And it was a series of market dislocations happening in thinner markets in a part of the week, obviously, too, that is characterised even typically by thinner liquidity. That's being the start of Asian trade on a Monday, and we saw this really significant meltdown across markets as there was sort of forced liquidations, as well as some really crazy dynamics, obviously, in volatility markets, which will probably take a few days, if not weeks, to actually pick apart. How we saw things like the VIX get to 60 last night. So my sense is that we're getting closer towards the end of this kind of manic kind of price action, because it was very much driven by technical factors. The question remains, though, how much of those fundamental reasons that set off this sell-off continues to paint the same picture, which is of slower economic growth, or whether some of the data that we got last week, again, which was the initial spark, is really just a flash in a pan.
So, Kyle, a couple of questions then. In this market environment, where, as you say, it's pretty manic, do you run for cover in safer bets, or would you be buying the dip, especially in those high-flying tech names, for example?
Well, I think you need to see the dust settle a little bit more, and you need to see that kind of evidence that the technical factors that are driving this sell-off have started to ease, and that there are fundamental reasons to look at to suggest that the US economy isn't going to fall off the cliff into a recession, for example. However, I think there are trades, if you zoom out and look in the bigger picture, that even with what we can know about the fundamentals are looking reasonably sensible, and those are things that are positioning effectively for lower US yields, things that might be able to play an imminent rate cutting cycle from the US Fed. And those are things like long gold positioning long in gold, which ought to benefit from not only this kind of instability in markets, but looming interest rate cuts, a slower economic growth environment, as well as some of these geopolitical risks around the world. And it's also buying the dips in yen. Effectively, we have seen again this kind of manic price action, as we've been calling it, being kind of compounded by the unwind of very significant trades. But again, underneath those kind of very, very noisy machinations, there's a reason to believe now that we've seen an inflection point in the global economy, and that buying the dip in yen now is the sensible trade. When it comes to equities, I think it's a little bit too early to say, and I think we still have a little bit of froth to blow up some of these very, very significant, what were very significantly inflated asset valuations. But for now, there are trades that investors can participate in, which can play both the short-term and the long-term factors here, and turn this kind of volatility into a level of opportunity.
Carl, and it takes us to our question of the day, right? Will the S&P end the week higher or lower? Does it feel like, even if we do see this kind of rebound, this is obviously, a market that either overshoots the upside or overshoots the selling as well, right? Going forward, do you expect more frequent bouts of volatility? Because it seems like the things that investors want to see, better eco data, a Fed easing, better earnings reports, better valuations, all of these are going to be quite hard to get in a combination, particularly with geopolitical risk overlaid.
Yeah, I think the next 3 or 4 months, even before this sell-off, was going to be a fairly volatile period, and one which risk assets were going to struggle. Even if we go back a few weeks when we started talking about the rotation trade and some of the big sell-off that we saw across, at least in the headline, for major US indices, valuations were rich, positioning was very, very strong. Futures positioning was at sort of a 3-year high in terms of long positioning, market sentiment very bullish. So that had to blow off to some extent anyway. The difficult thing now is that we've seen basically the balance of risk shift in the US economy. The Fed has highlighted that, and all of a sudden, rate cuts aren't the kind of thing that is going to pad asset valuations and support market sentiment. If anything, we're going back to a situation now where bad news is actual bad news, and we're going into a very fraught political environment, an environment where earnings look like they could potentially peak, and that the US economy might be slowing down. So this is still a kind of, fundamentally speaking, a negative backdrop for asset prices that can still pull back some way before we start to see, again, sentiment, positioning, all these things begin to clear. And we will probably see continued periods of this sort of heightened volatility, at least in certain parts of financial markets, as we see some of these very extended trades begin to be unwound. I suspect this event will probably be over the next couple of days, once we start to see that the US economy isn't necessarily falling off a cliff, but it still seems that we've hit a bit of an inflection point, that given the fact, like you said, earnings is mediocre at best. We're seeing the interest rate cycle no longer being a tailwind for the markets, and it has to be said too, a period of seasonal volatility because of the election in November, which normally sees, even at the best of times, US markets underperform. So I think the risk is ultimately skewed to the downside. I just don't think we should be drawing too many cataclysmic conclusions over the last couple of days of price actions, which is very much a fairly esoteric or set of events based on the technicals in Japanese financial markets.
Oh, the price action at the moment, though, Kyle, the topic's up by 7.3%, the Nikkei about 7.5% already. We knew it was going to be a crazy session with that circuit breaker and the limit up. But I did wonder, you were saying earlier about how Japanese equities are, typically an inverse kind of trade to the yen. Haven't we moved beyond that, though? Because that's what's sort of been driving the narrative for this rally, that for a number of factors, we're seeing value in Japan.
Yeah, potentially. We're going to see a lot of dislocated price action over the last few days, and maybe I'm a little bit naive by just putting together my little overlay charts. But if you look at the USD yen and the Nikkei, more or less they've trended in a very similar fashion. And if you look at the price action over the last couple of weeks, and again, it's first driven by effectively there was a huge short squeeze in the yen, compounded by this sort of unwind of the carry trade. Is that simply when the yen rallies, the Nikkei looks less attractive on a nominal basis, and it tends to follow suit. So I think I tend to think that the risk is skewed to the downside for the Nikkei, because I still think, although this move in the last couple of days has been a little bit too rapid in the yen, and again that's a technical story, there are still fundamental reasons under that sort of sparked, I suppose, that kind of significant move, which will still take months to play out, and that's effectively that the global economy is shifting to a sort of a weaker footing. The US economy is going to be a little bit weaker as well, and unfortunately the Bank of Japan maybe has chosen a fairly inopportune time to raise interest rates in that environment. So I still think I still think that we'll see a stronger yen. I still think quite simply that'll mean that we see a weaker Nikkei. The next few days of price action, though, is just going to be irrational. And I think it's kind of that mistake that sometimes market participants can fall into by sort of seeing this kind of price action as being, reflective of rational expectations of the future, rather than just some very noisy markets that, really need to kind of, become efficient once again over the next couple of days before they actually start reflecting economic fundamentals.
Carl, great to have you with us. Carl Brother, Senior Market Analyst at Capital.com. More ahead on the Asia trade. This is Bloomberg.
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's hand-picked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive, premieres Friday only on Bloomberg.
Hong Kong-based power utility CLP has reported an 18% jump in first-half net income, keeping its interim dividend at 63 Hong Kong cents per share. The company says it plans to focus more on importing mainland nuclear energy to Hong Kong as the city tries to decarbonise. Let's bring in the CEO, TK Chiang, now to talk more through these results. TK, great to have you with us. So give us your assessment of, I guess, how satisfied you are with the level of growth at the moment.
Yeah, this half year we have a very strong financial performance with 18% growth in our total earnings compared with the same period last year, and we have a very good, I would say, operational delivery. We completed our second CCGT in Hong Kong, 600 megawatts, D2 units. In Australia, we also completed our 350 megawatt Tarara B gas turbine unit. At the same time, we maintain very good, financial, structure and good credit rating. In future, actually, we are planning to expand our renewable energy portfolio, both in China as well as in India. In India, actually, we have not only in our renewable energy assets, but also expanding in transmission lines as well as smart meters. So I see huge opportunities during this energy transition around the world.
I wanted to ask about Hong Kong as well as the mainland. And when it comes to Hong Kong, what's your profit outlook over the next few years? Because it still seems like commercial activity, economic activity remains very sluggish. Are you optimistic about a stronger rebound? Because it does seem like, with population decreases and lower utilisation, that may not be coming.
Yeah, in Hong Kong, I think we are seeing challenges in the economic, situation in Hong Kong. But of course, we, hope that it would basically turn around, later this year or next year. But in terms of the electricity demand, actually one of the most important driver actually is weather. For example, this year we see, hotter weather as compared with last year. So we, for the first 6 months, we do see 2.6% growth in our sales. Regarding the different sectors, basically in retail and commercial segments, we do see slower growth or even negative kind of reduction. But in other residential and public services infrastructure, we do see quite solid growth. But it would be more affected by weather.
TK, you mentioned the green transition. When it comes to Hong Kong, does nuclear power play a role?
Yeah, definitely. I think nuclear power has been kind of recognized as a zero carbon energy and play a quite important role in during the energy transition. Now, the Hong Kong government has published the Climate Action Plan 2050 and have set a target, to have 60 to 70% of zero carbon energy, among our fuel mix, by 2035. So we expect actually we need to, through regional cooperation, to import zero carbon energy, from the mainland, in which it would consist of nuclear and renewable energy. But in terms of volume, I expect actually nuclear would be, the major one, because nuclear power actually would be more stable and dispatchable, whereas for renewable energy, it's intermittent, and we need to have, other measures to make sure that we have a stable power system.
So does that mean the CLP is potentially planning new nuclear plants to serve Hong Kong? And what is your strategy also in the mainland market?
Now, in terms of for Hong Kong to import power, I think we also need support from governments both in Hong Kong as well as in the mainland. So I think apart from so-called discussions between enterprises, we also need to have government dialogue in order to make this a kind of joint effort. In terms of our investment in China, actually we continue to look for investment opportunity in nuclear power also in the mainland.
The recovery when it comes to Australia's business is interesting, right? First half profitable after a pretty significant impairment in the previous year. What's your outlook for that market, and what was sort of key to that turnaround?
Yeah. So in Australia, we do see a good turnaround, and back in 2022, at that time when the international fuel prices was so volatile and the wholesale price shot up quite significantly, our generation plant actually had some problems. And since then, actually, we have been investing in improving the conditions of our power stations in Australia, and we do see improved performance. And we have 2 units in Yallourn Power Station. We have 4 units in Yallourn Power Stations, and we have completed 3 outages, and the last one will be completed in Q4 this year. So after that, we do expect the performance will be improved, and reliability will also be increased. And at the same time, in Australia, I think the competition in the retail business is very intense, and the energy price is also expected to stay in a high level. So, in terms of the margin for retail business, there could be pressure.
TK Chan, good to have you with us. He's the CEO at CLP, joining us on a very busy day when it comes to market moves. Take a look at some of these stocks that we're watching at the moment, because, of course, we have the likes of chip makers such as Tokyo Electron reporting this week, and we have seen that huge rotation out of some of those tech names. But we are seeing now in this session the rebound, a very strong one, with Tokyo Electron gaining more than 12%. And remember SoftBank in the previous session, he had actually lost billions of dollars, $15 billion to be exact, on Monday alone from its market value because of the massive wipeout that we saw in the broader markets. We continue to watch those gains in today's session of SoftBank of more than 10%. We're also watching financials in Japan. It was really a week of volatility for some of the biggest banks. We're talking about $85 billion being wiped out in the last 2 trading days for Japan's 3 biggest banks. Of course, we had that huge really decline and plunge in JGB yields in Japan. We were talking about the 10-year yield falling by the most in more than 2 decades. Right now, we're seeing a little bit of a rebound on those JGB yields. We have more ahead on the Asia Trade. This is Bloomberg.
You're watching the Asia Trade, the latest stories we're following around the world, and Bangladesh's army chief and president are calling for calm after Prime Minister Sheikh Hasina fled the country following anti-government protests. Authorities say a curfew will be lifted on Tuesday and that election will be held as soon as possible. Hasina had faced pressure to resign for weeks as peaceful protests over government job quotas turned deadly. US Vice President Kamala Harris has reportedly narrowed her search for a running mate to two candidates. That would be Pennsylvania Governor Josh Shapiro and the Minnesota Governor Tim Walz. That's according to Reuters, which also says Harris is set to announce her decision by Tuesday. The Democratic National Committee plans to virtually nominate a 2024 presidential ticket this week. US Secretary of State Antony Blinken says officials are engaged in intense diplomacy to avert a wider war in the Middle East. He says the US and its allies are working to head off a potential Iranian attack on Israel, urging all parties to refrain from escalation. Tehran has warned that it will respond after blaming Israel for killing a top Hamas leader last month in the Iranian capital. Let's take a look at how we're setting up when it comes to European futures. And of course, what a rebound that we're seeing at the moment in Asia, particularly when it comes to the price action across Japanese stocks just jumping. But there is a sense that confidence across the region is still pretty fragile. But take a look at Euro Stoxx 50 futures, tracking what we're seeing across the futures picture, and cash trading here in Asia higher, about 0.9% higher there. German DAX futures also looking like we'll see a big jump at the open as well. European stocks in the previous session really in sympathy with the global sell-off, dropping with that regional benchmark to the lowest since February, and of course this deepening global retreat. But it does look like at this point that sell-off was really overdone, or considered to be overdone, because we are seeing that sort of whipsaw positive price action now, Shery.
Yeah, we're seeing even sovereign bonds across Asia right now under pressure. Take a look at 10-year JGB yields that are rebounding. And remember, this is after falling by the most in more than 2 decades. The 10-year yield in Japan had been at around that 0.75% at the close in yesterday's trading session. That was the biggest fall since 1999. We're seeing a little bit of a rebound when it comes to JGB yields. We're seeing a rebound when it comes to 10-year yields in the U.S. as well. And this is, of course, after the 2-year yield fell below the 10-year yield for the first time in more than 2 years. And this really not surprising, given that the disappointing economic numbers from last week leading to some to start to price in potentially a hard landing, right? So traders had priced in at least 5 quarter-point Fed rate cuts in 2024. In fact, a 60% chance at one point of an emergency rate cut. A little bit of a different picture when it comes to Australia. Of course, there's a little bit more caution in the Australian market today, given that we do get the RBA rate decision today. The expectation, Haidi, to stand pat with a hawkish hold.
Yeah, watching that hawkish bias, whether or not the events of the last few days, the data that we've had as well for inflation starting to soften in Australia, whether that warrants a dropping of that hawkish tone. But take a look at commodities. Again, a green day, really mirroring that rebound that we're seeing across other asset classes as well. Brent crude up by 1.6%, really advancing after a 3-day rout, with signs that maybe that global equity capitulation is starting to ease there as well. The halting of production in Libya also helping. We're also seeing a rebound for the likes of copper and iron ore too. This is Bloomberg.
I am of the view that we will look back on this and say it was an overreaction in certain parts of the markets, and the market got carried away by demanding inter-meeting cuts, by demanding 75 basis points in September. It's not going to happen. It's not going to happen. The Fed will look at the economy and say, yes, it's weakening, but this is not an emergency situation such as the ones we've seen before.
Bloomberg opinion columnist Mohammed Al-Arian, they're speaking with our colleagues Alex Steele and Scarlett Fu. And certainly this idea that this short-lived capitulation, intense as it was, may have been overdone is certainly what's playing out when it comes to this recovery. Still, it is a choppy recovery that we're watching here. Of course, a big rebound in the topics, really kind of just showcasing the severity of the sell-off, right? The rebound, even with this pricing that we're seeing, doesn't cover even half of the sell-off that we've seen since the middle of last week. week when we had that surprise BOJ decision and that reversal of the yen trade. So the question is, Shery, maybe panic selling has kind of run its course, but what does it mean for investor confidence and I guess expectations? And I guess to that, we may have to go back to looking at the data.
Yeah, for more, let's bring in Bloomberg's Asia Economy and Government Senior Editor Brian Fowler and Senior Asia Stock Reporter Haidi Sano. And Haidi, let me start with you because today we've been talking about all of this market action being pretty manic. Haidi, yeah, so tell us a little bit about what's going on because we have seen really the Japanese government trying to really encourage retail investors to get into the markets with NISA accounts, for example. I mean, this must be really nerve-wracking for them.
Yeah, it must be. And yesterday we saw a massive selling, which probably is triggered by selling by retail investors buying Japanese stocks on margin. I mean, if you look at shares that have been popular with these investors, I mean, Japan Tobacco is one example. They have fallen, in a scale that is almost unprecedented. But on the other hand, if you look at the market today, it's rebounding. And also, I think it's interesting to point out that we have started to reach out to retail investors. And, it's still a small number to be called a survey, but at least many people seem to be very upbeat about the market despite the fall. So,
I mean, given the financial market meltdown, though, that happened in yesterday's session, Brian, we saw these criticisms about the BOJ, about the timing of the rate hike last week. But I got to say, I mean, this must be a very difficult position for them to be in. And today you get the data, wage growth, and it looks pretty good.
Yeah, so I think going back to the stock price fall, I mean, for the BOJ, the real concern isn't necessarily the fall itself. It's what's driving it, which is concerns about the U.S. economy slightly on the rise now, possibly slipping into a recession. And that's, of course, a risk for the global economy, including Japan. So the BOJ can't ignore the stock market. And I think if the turmoil were to continue, it would be fair to say that the likelihood of another rate hike this year is pretty much non-existent. Having said that, for now, the BOJ is going to be focused on the eco data, and the market movements don't really affect that, I think, especially because even with the NISA program, such as it is, the proportion of Japanese investment in stocks isn't quite what you see overseas in the U.S. and elsewhere. So the data are important, and today we saw real wages rise for the first time in 27 months. We saw gains far exceed expectations. Now, some of that, I don't know if that momentum is going to continue. It seems that some of that gain was a reflection of retroactive increases, wage increases that took effect going back to April and are just now being reflected in payroll. So we may not see the same momentum in months ahead, but it's definitely a positive, and it brightens the possibility of the virtuous cycle in which we see wage gains feeding into more spending, which then hopefully spurs demand-led price gains, and that's what the BOJ has been looking for some time.
And that last point, the data today for household spending was still quite sobering, right? We're still seeing weakness there. And I guess my broader question about this Japanese kind of revival story is when that virtuous cycle will start trickling through to the mindset, which has been so stark by these many years of deflation. We had that great story about, people and companies that are having to take lessons in learning how to maybe ask for more money to raise prices, right? How difficult do you think that's going to be?
Well, Heidi, that's the big question overhanging Japan's economy. Is Japan back, and what does it really even mean to be back? There's the demographic problem is there and is not going to go away, so that's always going to weigh on output, production, and that's going to kind of put a cap on what the potential growth rate for Japan really is. Having said that, these wage gains at this point, even through June, we're probably only seeing about 80% of those wage gains that were won by Rengo factored in. That's according to BOJ reports in the past. So that we will continue to see a little bit of that effect going forward. Consumption has fallen in every quarter for the last year. At some point, it pretty much has to bounce just based on base effects, if nothing else. So we should see a little bit of a bump going forward. I guess the question is how big will that bump be, and that's only time will tell.
Yeah, I mean, you mentioned consumption and household spending today, also a contraction of 1.4%. But, Hine, I want to get to you because I just wonder what the view is about the Japanese stock markets right now. Has any of this affected fundamentals?
Well, that's a very tough question. I think one thing I can say is a lot of speculative buying positions have been already cleared. So the positioning is very light at the moment. So that's positive for the market. But looking forward, I think a lot of perhaps the most important point is the global economic outlook, because after all, the Japanese stocks are global cyclical plays. So for companies like Toyota, Sony, I mean, the consumption in the United States is a very important factor. And if the US economy is going to a recession, as some people seem to be expecting now, then probably Japanese stocks are not the best place to be. But on the other hand, if you expect the US economy to go into soft landing, then I think we still have a story in Japan.
What a story. What a story it is today, right? With seeing the top is gaining 9%. NIKKEI is close behind at 8.6% in this rebound. Our Asia Economy and Government Senior Editor Brian Fowler there, also our Senior Asia Stock Reporter Hideyuki Sano there in Tokyo. More ahead on the Asia trade. This is Bloomberg. Well, now in our exclusive series, taking you inside India's Adani Group, and Karan Adani is billionaire Gautam Adani's elder son, who oversees businesses including cement, ports and logistics. They provide much of the critical infrastructure, allowing global companies to plug in to India's $4 trillion economy. Adani is now planning to take over seaports in the Middle East, Africa and Southeast Asia as it tries to challenge China's dominance in key trading infrastructure. In our exclusive interview, Karan Adani also dismisses the allegation that the group's fortunes depend on their close ties to Prime Minister Narendra Modi.
This man holds the keys to one of the biggest logistics businesses in Asia. Karan Adani is the eldest son of Gautam Adani, the Indian billionaire who built a sprawling infrastructure empire that's pivotal to the country's economic ambitions. He's been handed the reins to some of the most important businesses for the Adani Group, including ports. Karan is visiting the Mundra port in India's Gujarat, the home state of Prime Minister Narendra Modi, whose policy priorities the Adani Group has closely tracked as part of its business strategy. Mundra is where it all started for the group, which is now India's biggest private operator of ports. Maintaining and building on that growth will be a key challenge for Karan. He is one of the 4 family members handpicked to run big chunks of the Adani empire as part of his father's succession plan. However, the firm's meteoric rise has been overshadowed by accusations it's benefited from cronyism. It also took a multi-billion-dollar hit from the explosive Hindenburg research report, with a short seller claiming the Adanis engaged in fraud and stock manipulation, allegations that they've denied. Bloomberg's Anto Antony sat down with Karan Adani for an exclusive interview and asked him about the challenges ahead.
The group's rise has been closely linked to Prime Minister Narendra Modi, but at the same time you are working in several other states with other governments also. How do you do the balancing act there?
Being close to a political party does not necessarily mean that you get the work. You get the work because you are able to deliver, you are competitive in a market, and we have run it in a most efficient manner. You don't have these 3 things. There's no point being close to any political party, because today's India is no more about giving favors. It is all about whether you're competitive in the landscape or not.
Many of the investments which the group is making, whether it's in Sri Lanka or Israel, the way in which many analysts are seeing it is like you are playing a strategic role for the government of India to facilitate certain trade routes. Now, as a group, you balance the requirement to serve a strategic need and at the same time maximize profit as a publicly traded company.
So I think certain positions that we are taking is also strategic for us as a company, because going back, we do see that there's going to be continuous disruption. And we look at where are the major trade routes from India and how do we minimize those disruptions by having a position over there. So that is the first fundamental one. And second is obviously if you look at from a geopolitical perspective, yes, India has certain geopolitical priorities, but that doesn't mean that those priorities are companies' priorities. We take our individual assessment. End of the day, we look at risks, we look at profitability, and for us, family is also one of the largest shareholders. So we have to do justice to the family as well, apart from the minority shareholder, because end of the day, all the investments that we are making, whether it is in power or whether it is in ports, these are investments which have to give returns on a standalone basis.
Adani Group is known for chasing scale. What would be the global ambition like as you oversee the business over the next couple of years?
I would not say we have a global ambition. I think the ambition is by 2030 we want to be handling at least 1 billion ton of volume, predominantly coming out of India, because as India is going to grow, the trade is going to grow, and obviously and we are in the right position to take that sort of growth. I think the second part is to give a reliable supply chain solution into our neighboring countries and making India as a center point of that whole supply chain. And that is the idea, that how rather than cargoes getting transshipped in Dubai or in Singapore, how do we make India as a center point of the overall supply chain from east to west? And that's where we are looking to play, to create that larger vision of making India as a center point. Wherever we do believe that we have to take a position, we are happy to take a position over there.
When the Hindenburg short seller attack happened, it must have taken a lot of management bandwidth and mind space away from chasing this vision. Now, how did you deal with it personally, and what role specifically did you play at that time?
So at that time, basically my responsibility was three things. One is obviously to make sure that business resilience continues, not just in ports but across the group, in terms of our performance, in terms of our operational efficiency, in terms of our capital capex efficiency. So that was number one. Second was to ensure that from a leadership perspective, we were completely aligned. There was no critical people leaving during this time, and they were ensuring that we were all working together to achieve the goal, to make sure that we weather the storm. And that's what that was a main priority, to make sure that whatever performance parameters that we have achieved in the past, we beat that during this period.
One overhang, even right now, is the kind of investigations or probes which are there into the company. And also at the same time, there are allegations regarding opaqueness in the holding structure. How do you assuage the investor concerns on this front?
See, I think if you look at from investor perspective, right, as a group, we went through this transition from 2007-8. So if you remember, in 2007-8, we had a holding structure. We had Adani Enterprise, and then we had all the other companies which were subsidiaries of it. And again, going back to getting feedback from the investors, they said that we would like to have a clean structure. And that's where we started demerging. So ports got demerged, Adani Power got demerged. So basically the shareholders who want to invest in ports, they know that they come into APSZ, or investors who know that they want to only invest in energy, they know that they want to come into renewable. So one is, there is a clean structure from a holding perspective. So there is no crisscross holding which is happening. So it's a very clear structure. Family holds directly into each of these entities. Second is, when you look at from a family perspective, family holding perspective, all of that has been disclosed, because we have 23 or 25 international issues, bond issues across various group companies, again rated by all international agencies, investment grade rating. And part of it, unless you don't disclose all of this, there's not much of, you don't get through that hoops of getting that rating. All of that has been disclosed. Now, coming to investigations and other things, where the issue would come is if, as a group, we have not disclosed something. All the investigations that so-called Hindenburg report has been talking about is all disclosed, whether it is in our annual report, whether it is in our bond issuance, or whether it is in or any of our IPOs as well. So if you remember, before Hindenburg, just before Hindenburg, there were 2 IPOs which we did. I mean, demergers we did. One was the demerger of Adani Total Gas, and then the second is again the IPO of Adani Wilmar. Now, all of this, SEBI will not give you clearance if you have certain issues going on.
Your father is a first-generation entrepreneur who, from the scratch, built one of the largest conglomerates in the region. When the transition happens, for you to step into his shoes, those are some pretty big shoes to fill. How will you go about it?
As you move from first gen to next gen, I mean, we realize that what they're leaving us behind is a sort of a legacy, as well as not just a business, but a platform which we have to protect and ensure that we pass on to the next generation as well. We also realize we can't work the way he is working, in the sense that his risk appetite is much higher than what ours is. So we realize where our shortfalls are, where our strengths are, and we work on our strengths, and whatever we have learned from him, all the wisdom that we have learned from him, we try to work on it on a day-to-day basis.
But hunger for growth is something which differentiates Adani Group from many others, as Mr. Gautam Adani has said. Now, risk appetite is a key part of it. Why are you saying that in the second generation, the risk appetite could be slightly
It is bound
less?
to happen, right? So this is evolution of life. First generation, you have grown from nothing. Your risk appetite is much higher because even if you lose everything, you're back to where you had started. We are starting from a level which is something higher than what they have started. So we have a larger responsibility to make sure that we protect and to grow from there.
Mr. Gautam Adani has talked about the middle class values that the group espouses. Now, the second generation has mostly born into wealth. Is there a pressure to come
I would
for?
differ over there a little bit, because we've not been born into wealth. A large part of our childhood has been through a struggle as a family. It's just that in the last, 15, 20 years is what we see. But a large part of our childhood has been of struggle. We have seen our parents struggle everyday basis. We have seen them go through tough times as well as good times. We have seen them aspiring for more and working hard. And we have seen them dream together to reach to that aspiration. And we have also seen a lot of support from the larger family, and more importantly, valuing what we have.
Karan Adani there, speaking exclusively with Bloomberg's Anto Anthony. A special coverage of the Adani Group continues all week. Tomorrow we'll be hearing from Gautam Adani's nephew, Sega, who oversees the group's power and finance businesses, about the fallout from the Hindenburg report.
From our viewpoint, purely this report was nothing but accumulation of everything that was written and alleged over the last 10 years before that, but also very beautifully gift-wrapped and presented in a way that was, explosive and shocking.
And our coverage culminates with a special report on Friday at 11:30 a.m. Hong Kong time, with an encore presentation at 7 p.m. That's 4:30 in Mumbai. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to crypto. Of course, we saw that being a part of that broader sell-off as Bitcoin, Ether tumbling, the biggest declines that we've seen since the collapse of FTX. So really joining in that battering of risk assets. We're seeing, again, that cohesive turnaround, though, as we see equities recovering in the Asian session as well. Bitcoin now up by 2.6%. We're also seeing that recovery to a better extent when it comes to Solana as well as Ether as well. But really that sort of battering really not leaving crypto immune, despite, of course, we've seen in previous sell-offs the likes of crypto almost acting as a bit of a counter-cyclical haven asset. But a lot of these crypto-related stocks this time around also seeing a big decline too, Shery.
And Heidi, one stock that we're watching when it starts trading is TSMC in Taiwan. Morgan Stanley is saying that its U.S.-listed shares are a top pick as the stock is attractive again after dropping more than 20% off a July peak. Analyst Charlie Chan says he likes TSMC's quality and defensive nature during an elongated semi-down cycle. Morgan Stanley has an overweight rating on the stock, and of course we saw the biggest one-day loss since 1967 for the TAIEX index yesterday, and TSMC losing nearly 10%. Look at futures up 6%. Heidi, I just have to wonder, is this going to be a blip? Because we're talking about the Nikkei right now gaining more than 10%. Same for the topics. They lost about 12% in the previous session. So are we just going to go back to those levels where we were? And Monday, it was like it never happened. Still, volatility pretty high, isn't it? Nikkei volatility at one point at the highest ever since we had data going back to 2001.
Yeah, and we've got to remember some of the sort of black swan hedging trades that we saw as well, right? And it's a reminder of, as we spoke to John Authors earlier, that perhaps a real capitulation, we kind of also need to see some sort of institutional crisis, or perhaps that would be geopolitical developments or even domestic US political developments as well. But at the moment, we are seeing that recovery on RBA day, so a little bit more muted here in Australia with that in mind, 0.5% higher. This is a market that is also, at pretty close to record highs, and we do have some concerns about a softer earnings season coming forward as well. But it seems to be this recovery is on foot, the rebound that is, but sentiment does still look pretty fragile. We'll continue to watch these markets very, very closely. The China show is next.